everybody. Welcome to the October Lear Market Update and Strategy webinar. My name is Tom Steinley. I'm the Director of Business Development at Lear. We're joined today, as we are each month, by our Head of Research and Co-Portfolio Manager, Jim Warner. First, I'd like to thank everybody for being with us today. It seems like more people have registered for this webinar than usual. I imagine that may be due to all the media noise and how it could be affecting the markets. September marked a second straight month of market decline, and October isn't off to a great start. The Fed has indicated it may keep interest rates high for a bit. The government just narrowly avoided a shutdown, and there's a concern about the recent turmoil in Congress. Jim, hopefully you can make some sense of all this for us and give us an idea of how it may be playing out in the portfolio. Before I hand it over to you, I just want to remind everybody on the call that we encourage questions, and the way to do that is submit all your questions through the Q&A box at the bottom of your screen. Okay, Jim, all yours.
All right, great. Let me share my screen as I normally do. Thanks everyone for joining us today. The title of this market update, as you can see here, is long-term interest rates surge as deflation creeps closer. And if you recall, last month, we made a pretty big call, a call that is probably among the few people on the street talking about deflation. And we've seen more evidence that's starting to kick in. And obviously that has some interesting impact as to what long-term rates ultimately will do. Now, clearly they have surged dramatically in recent weeks. So we'll talk about that. So the quick take here is that, the material sell-off, if you recall, we've gone back and done an analysis of what I like to call material pullbacks. And those are anytime the market pulls back 5% from its prior high. So we're about 7% now down from the prior high, a little bit more on the NASDAQ. And if you recall in our analysis that we published a few months ago about these material pullbacks, that typically on average, and when you get a pullback, it's about a 7 or 8% kind of pullback. And so what we're experiencing right now is actually fairly normal. Now, what's not normal is what's happening in the interest rate market. And Tom alluded to this, and that is certainly the culprit of why we're seeing the pullback. Now, why is the case? Well, when long-term interest rates rise, it means that companies have a higher cost of capital, and asset valuations need to decline. And so we've seen that happen across both the bond and stock universe. We're also starting to see early signs from companies that interest rates are going to take a bite out of growth and or profits. Just this week, there was a utility, we actually owned it, that came out and guided to half the revenue growth that was expected, partly because they can't get the financing that they need to grow it at attractive enough rates. So this is going to be a theme that we're going to hear a lot, I think, over the course of the next month as we get into the 3Q earnings season. So we're taking a cautious stance, generally speaking, when it comes to companies that rely on leverage, because it's obviously gotten a heck of a lot more expensive. One of the other things that's happened recently is obviously oil prices have surged. This is due principally to low storage levels, but that could also present a new economic headwind. And then we finished up the month last Friday with core PCE showing some real signs of slowing spending and slowing inflation. And we'll dissect that here in a minute. So, but all in all, the economy is still quite strong, but it is slowing. And in our estimation, right now, the market is basically, both the stock and bond markets are way oversold. And we think that interest rates are going to start to head back down here in a bit. But, we'll see. And as I mentioned in my intro, I think there's more and more evidence that the economy is on a path towards deflation. So looking specifically what happened to the long end of the curve, you can see that it moved up pretty dramatically during the course of the last month. This is the Fed's favorite mantra, higher rates for longer. And of course, they reiterated that numerous times. And, up until a few weeks ago, the market had pretty much ignored that. We've obviously seen higher long-term rates, but in the last few weeks, we saw a huge correction. So that's bad for stocks and bad for bonds. And as I mentioned, it increases the concern on what the economic impact of these higher rates will be. And it does raise the question of whether there's going to be a Fed policy error. And will they actually end up raising rates too far? And what impact would that have in terms of increasing the chances of recession? But these longer term rates definitely support our thesis on lower home prices. I caught a little bit of blowback for that call last month, but I stand by it. Their home prices are headed lower. It's the last asset bubble to deflate, which then is going to support our thesis on deflation. So, we actually expect that there's going to be a bit of an unwind from this recent rip that we've seen at the long end of the curve. So looking back at where we stand, the S&P is now up only 13% for the year. The NASDAQ is up 27, big pullbacks during the month. And yesterday was another, pretty ugly day. Now, interestingly, we've talked a lot about how the top 5 or 7 large cap tech names have been driving all of these returns. And I think the visual evidence is pretty obvious, and the quantitative evidence speaks for itself, that if you look at the equal weighted S&P 500, it's barely up for the year. And these are numbers that are actually through last Friday, so it actually might be down on the year. Similarly, the aggregate bond index is down a percent or two now for the year. So this is pretty wild, right? Now, basically, if you didn't have those 5 or 7 top tech stocks in your portfolio, you're basically flat for the year. So that's why the portfolio returns broadly across any manager that you look at are pretty weak this year, because bonds aren't working and really stocks aren't working outside of just a handful. If we look a little bit more at what's been going on for the last few years in bonds, it's basically been a total bust. If you bought bonds back in 2018, you've made no money, and that's including the interest income. So, this is a horrible situation for obviously conservative investors and savers. But are we at a capitulation point? And is it maybe finally an opportunity to really make some money in bonds? And that's what we've been spending a lot of time on. If you recall, the last time we had very high inflation was back in the early 1980s. And if you remember, what happened is that as CPI fell, right, the measure of inflation, this is the red line in this graph, as it fell, bonds, which is represented by the black line, started to accelerate. We started to see appreciation. And it's not just appreciation in terms of just clipping coupons, it's actual, the value of these bonds actually increased. And not just for a brief period of time. This bond boom lasted 3 decades. Now, I think one of the questions that we're asking ourselves is, are we at that point in time today? Now, we might be 6 months early on that call, but the reality is, one of the most attractive things you could possibly buy post a big inflation bubble are bonds. And where we sit today, you can see here the yield to worst on some of the major bond indices. They're offering some fairly attractive yields, up north of 5% and even close to 9% on high yield. So, we may be at the beginning of a really interesting boom in bonds. And just to give you an example, and I'm giving you the exact same example I gave you 2 years ago when I said that inflation was not transitory, that we had to get out of long duration fixed income because they were going to be in trouble. And the reason why was convexity, right? Convexity means the bond sensitivity to changes in interest rates. And, back in 2020, that sensitivity was extremely high. You can see in this IBM senior notes, which have a coupon of 2.95%, and they are very long duration because they have a 30-year maturity. They traded north of par back in 2020, then proceeded to lose 40% of their value, right? So we can now buy this bond at 59 cents on the dollar. So if we run this out and we look at the yield to worst, which in this case happens to be about the same as the yield to maturity, you could basically earn 6% every single year for the next 27 years. And so long as IBM doesn't go bankrupt and doesn't default on these bonds, that is called the pull to par. These bonds will ultimately be mature at 100 cents on the dollar, right? And we're at 59. So these are the kind of unusual opportunities that are being produced by this market. Now, the other really cool thing about this pull to par is that most all of it will be taxed as a capital gain, not as ordinary income. So, if you really step back and think about it, almost everybody on this call has never seen an environment like this. This is a very, very rare situation where you could buy something that is as safe as an IBM bond and get an automatic 6% for the next 27 years. That's the kind of interesting thing, interesting opportunities that exist out there. All right, so let's talk a little bit about our deflation thesis. And, we really think that we're getting more and more evidence to suggest that we're right on this. The Fed's favorite inflation gauge is the core PCE price index. And if you recall, that excludes food and energy. So we're going to exclude that from the conversation as we go through these next few slides. But just looking at that core PCE number in aggregate, it's growing now at 3.9% which is a big step down from July. So this, you can see it in this bottom left graph. And the other interesting thing is if you look at the month over month change, it was just 0.1%. And that actually annualizes out to only 1.7%. So that's meaningfully below the Fed's 2% target. So if this trend holds and we continue to see core PCE decline, then long-term rates are surely going to decline. So that's kind of the situation that we sit in today. Now, if we strip apart the components of core PCE, remember there's three pieces to it. There's durable goods, which are, the clothing, cars, etc. There's non-durable goods, which is principally food and energy. And we're going to basically not talk about non-durable goods because, again, it's not part of the kind of the core PCE, and the part that is not food and energy is very, very small. And then they have services. So, and that's the biggest piece. Now of so looking at the durable goods and the services PCE components, you can see the green in this graph, is negative. And so the durable goods are in a state of deflation. Prices dropped 1.9% in August, which is an acceleration from the prior months. So prices are headed lower and in a faster fashion in the durable goods part of the economy. In the services part of the economy, which is the blue line, the blue bars, you can see that it's gradually decelerated from 6% back in January to 4.9% in August. And we don't have the September numbers, but I imagine it's going to kind of tick down a bit there too. Now, what's supporting this is that 25% of that services number is housing. And we walked through this analysis a bit last month, but just to refresh you, that's coming down, but it's still 7.4%, showing 7.4% pricing growth. Now, I don't know about you, but there's probably nowhere in the country where anybody's getting 7% growth when interest rates, when mortgage rates are way north of 7% now. So remember, we now are sitting in a place where, in this housing situation, where mortgage rates are at multi-decade highs at 7.35%. I heard even yesterday it might have touched 7.5% in intraday, and we have record high prices. So our view is that buyers are getting completely priced out of the market by and large. On average, this is on average across the country. Yes, there are probably some cash buyers and some wealthy buyers here and there that don't need a mortgage, but that is very, very rare. And so we just think this is, basically Econ 101. We're going to have a negative demand shock. And that negative demand shock means that we're going to see falling home prices. Now, just as a note, the last time we saw this, of course, was during the housing crisis. And the median home price across the country fell 28% from the peak. Now, I'm not suggesting we're going to see that level of decline, but and recall, so the housing crisis was a credit problem. We don't have a credit problem today. We just have a price problem. So I do think that they will fall to some level, to some extent, and just how much, we're just going to have to wait and see. I've looked at this Zillow market data. This confirms, you can see the chart on the right, that prices aren't growing at all, according to Zillow's kind of real-time updates on housing prices. And you can also notice that since the beginning of the pandemic, that housing prices are about 40% above where they were back in 2019. So we've got, again, really, really high appreciation in home prices, home values, and we've also now got a really, really high mortgage rate, and that's a bad combination. So just to update these core PCE scenarios, again, today, housing, according to the government, is growing at 7.4%. And that's included in the 3.9% core PCE number. If we leave all the other inputs constant, if we have housing prices fall 15%, core PCE is going to be 0. So housing prices, just housing prices, not anything else, falls, pretty significantly. We could see an overall headline number that is, way below where the Fed's target is. So this is we think is going to be the biggest driver of the markets over the course of the next 6 months. Oh, and by the way, what about rents? Well, apartment rents have rolled over too. So this is some real-time some fairly frequently updated data from a company called Apartment List, and we're seeing rental prices down 1.2% year over year. And so you're seeing deflation occurring in the rental market as well. Now, while all this is happening, we still kind of live in this Goldilocks economy where our real-time inflation gauge from trueflation is returned back to kind of a normal level. We still have really great labor market. Spending is continuing, and even the services PMIs remain in growth territory. So as we sit here today, everything looks fine. However, a lot is going to hinge on how the economy digests higher interest rates and how long these higher interest rates are around for. So, what does this mean and why does it matter? Well, long-term interest rates, as you know, mean more to the economy than short-term rates, right? For consumers, it's what you price a mortgage off of or a car loan. For businesses, it's how you evaluate whether you're going to go forward on building a factory or investing. It's even going to matter in terms of whether you're going to acquire a company, right? All of it has just gotten more expensive. And so we really do need to wait and watch to see how the economy digests that and make sure that we try to insulate our portfolio as much as we can from companies that we think may have an issue, with financing one way or the other. And so we'll be watching for that very closely. And fortunately, we have an earnings season coming up where we're going to hear firsthand from a lot of management teams on how they're dealing with these higher interest rates. The one thing I would point out, though, is that if the bond market will react before the Fed is probably going to be late to the party. I think if the deflation thesis really happens, you'll see the Fed probably dramatically reduce the front end of the curve with rate cuts. But before they even get to that, you're going to see the bond market react at the long end. And so this little bout of sell-off that we've had in the bond market in the last couple of weeks, I think as we start to see the headwinds from these higher interest rates, ripple through the economy, you're naturally going to see the bond market react. And so it really brings us full circle back to could we be at the start of a new bond bull market? And I know that's very contrarian. If you turn on CNBC, everybody's running for the hills because of these higher interest rates. But I think ultimately what you're being set up for is potentially a really interesting bond trade over the next number of years, really. Our reaction in our portfolios, generally speaking, though, because of all the volatility, has been to de-risk in the short term, to build cash reserves, and then to really take advantage of the opportunities that are being presented. I left this in. This is the standard deflation playbook. It basically means protect capital, and that's basically where we sit today, largely due to the market volatility, not less so based on our deflation playbook. But I think the two actually kind of go hand in hand. I left this in here though for you guys to take a look at your own time. So what's the most likely outcome? My view is that the market has yet to realize that the economy is on a path to possible deflation. When it does, because the numbers will ultimately, I think, prove that out, interest rates will head lower. And in the meantime, though, there is this growing fear of how corporate earnings are going to handle not only high rates today, but let's think about how are corporate earnings going to hold up under a deflationary scenario, right? When businesses lose their pricing power, what happens to their margins? So it's going to be very interesting to see how this plays out over the course, and that's something that's going to play out over the course of the next 6 to 12 months, probably. When this occurs, though, this could still be a very positive environment for companies with defensive earnings profiles. And this would include technology, consumer staples, other sort of go-to defensive quality stocks that people tend to go to in times of recession. And you're also going to want exposure like we have to secular tailwinds, whether they come from the Inflation Reduction Act and all of the interesting subsidies that are going on there, or even artificial intelligence, of course, everybody's talking about. But also stores of value are going to become increasingly important, and that's cash and high quality fixed income. We know we're early on this theme, and the market hasn't come around to this viewpoint, but that's okay. We're going to be there and ready for it probably before anybody else. So as we get to the specific portfolio moves that we've been doing recently, I just want to touch on this for a second, and then we can go into questions. But basically, this infographic, some of you have seen this before. I try to include it in every presentation. Is the actual allocations that we have to various themes in the portfolio or assets in the portfolio, and what we've clearly been doing over the course of the last really month or so is really moved into kind of a risk mitigation mode. Our first job as investment managers and advisors is to protect capital. That's our number one job. And during the course of the last month, there's really been very few places to hide except cash and short-term treasuries and that sort of thing. And we've certainly increased our exposure there. We've also reduced our exposure to an infrastructure-related name, partly because of this whole issue with higher interest rates, higher cost of capital. What does it do to the return on investment? That's something that we want to avoid exposure to in the portfolio. So we've been raising cash. We now sit at probably the lowest equity allocation we've had since maybe March of 2020. When the pandemic first hit. So we're below 50% on our equity allocation, which is very low for us. But it's important to protect this capital so that we can also go take advantage of opportunities, which are becoming quite abundant, quite frankly. Again, you need to be patient. The market is a bit irrational right now, but eventually fundamentals do take over and do take command of even irrational markets. And so, the point that I make, the last point I make is do no self-harm. This is not a time where you want to be making radical bets, whether it's risk on or risk off. I think this bit of market volatility that we're having today is something that is essentially irrational, and it will clear up. And like I said, this could just be another one of these typical pullbacks we get in any bull market. So I'll leave it there, Tom, and then we can go to Q&A.
Terrific. Yeah, thanks, Jim.
And ask away. This is your opportunity to ask me tough questions.
Yep, you bet. And that's a good reminder. Please use this as an opportunity to get your questions answered. There's one in the queue here that says, do you measure the portfolio or portfolios that we manage against indices? And if so, could you share what those might be?
Yes. I mean, every portfolio has an index, largely because it's required to be GIPS compliant. We don't really measure ourselves to that index. It's more of a requirement. So it's very difficult, frankly, to measure yourself against when you're tactical and you're moving your equity allocation around to just benchmark it to a 50-50 or a 60-40 type benchmark. But yes, every portfolio does have a benchmark. We're happy to share that with you offline.
Yeah, and I will make sure that I get back to the person who asked that question and be more specific about what the benchmark is. Jim, there's another question here. Could this not be a repeat of Q4 of 2018, where the Fed continued to raise until year end, then reversed, and at the end of 2019 admitted they had made a wrong move?
It's entirely possible. I don't think that they're going to continue to raise. There's like a 30% chance of one more in November, but I think that the economic data, frankly, is going to start to weaken before that happens. But it's entirely possible. If you go back and look at other periods where the Fed cuts rates, it's always oh my gosh, we're late. We need to do it by 50 or 100 basis points every single time. And it's that knee-jerk reaction is frankly most likely the most likely scenario. So yeah, very, very, very difficult to know exactly what the Fed's going to do. I'm frankly more concerned about the long end of the curve than I am the short end, but I think the question you pose is a good one.
As a follow-up to that, are utilities stupid cheap here?
Yeah, very stupid cheap. Yeah, I think people I think there's a couple of different elements that are going on here. There's a big technical issue happening in the market that is causing rates to do what they're doing. And of course, utilities tend to be very sensitive to higher interest rates negatively. Yeah, I mean, I think that's one area where it's something we're discussing because it just seems kind of insane. All of this, by the way, like paint this scenario, we just surged 30 basis points. Okay, what if it all comes out of the market next week? Then the best performing sector, I guarantee, will be utilities. So yeah, I mean, if you're a short-term trader, I think that could be a very interesting play.
Jim, if our call on deflation proves to be incorrect, when would we make adjustments to the portfolio to reflect that, and how and what changes would you foresee in the portfolio to compensate for the fact that we're not seeing deflation?
Yeah, so I think the key is the path towards deflation. So I don't know how much lower prices need to go. The math is difficult, right? Because as we're on this path to deflation, there will be a lot of data points that we can point to either determine whether we're right or not, right? That's the most important thing, is that we're constantly looking at what's going on in the economy and whether or not that confirms our hypothesis, right? If it doesn't, then we make changes, and we make it usually pretty quickly. So, but I think where we sit here today is, I think it's going to be increasingly obvious to people that this core PCE is going to start heading down. I mean, just to go back, look at this. I mean, if we look back at this chart of apartment rent, this is CPI. Now, I know we've been talking about core PCE, but it's the same sort of lag problem that CPI has. This purple bar is the rent index. So you had this big surge up north of, 15 to 17% at one point in time towards the end of 2021. And then it dropped like a rock. Now, this little number here, this blue line, this is the CPI data. So even in August now, CPI thinks that rent prices grew 7.8%, when in actuality, this more real-time rent index is already negative. So, you can almost just continue to draw this blue line down and to the right. And so, I'm not worried about that part of the thesis, honestly. It's just a question of how far does it go. But I think that the table is set for lower prices, and we'll have plenty of opportunities to challenge our hypothesis and make changes as necessary.
Great. Let's see. What do you think about the market deciding that Apple is a low vol stock, as well as the other Magnificent Six?
Yeah.
It's no longer
what happens if China invades Taiwan? Not going to be such low vol, is it? I think frankly, I think Apple at close to 30 times earnings is silly. It's silly. Revenues aren't growing very much. We already know about how great their services business is. A lot is priced into that stock. I'm not, personally, it's not one that I like a lot. I also think it does come with some enormous tail risk. So yeah, I think a lot of these large cap tech stocks, not just Apple, have, some pretty lofty valuations that, any sort of slowdown in IT spend could impact them. I mean, these are not recession-proof businesses, right? And particularly not recession-proof stocks at 30 times earnings. But some of the stuff is driven by AI. That's exciting. That could keep multiples up higher here for longer. But yeah, it's definitely an interesting question. But and even if you just take a step back and draw an even bigger distinction between stocks and bonds, bond yields are so high right now that the hurdle you need to buy a stock is pretty enormous, right? I mean, generally speaking, at these types of interest rates, we should see lower PEs. So, I'm very careful around any stock, even a great stock like Apple that trades at very high PEs, because there's a lot of downside potentially.
Yep, fair enough. All right, let's wait for another 30 seconds to see if there are any more questions. And I would encourage anyone who has a question to ask it. This is your opportunity. While we wait, I wanted to just follow up and thank everybody for taking the time to be with us today. I will, as a follow-up to this webinar, once we get the client-approved version of the webinar and the presentation approved, which should be in the next 24 to 36 hours, I'll make sure that everybody on the call gets a copy of this. And as a reminder, they both should and will be client approved if you want to share those with select clients or prospects. And doesn't look like we have any more questions. So I just want to conclude by thanking everybody for taking the time to be with us. Thank you for your partnership and your trust. And we're always available to answer questions or help in any way possible. So thanks again. Have a great day and a good rest of the week.
Thanks.